BlackSky had a turning point after hours for its recent rallies after it announced a $143.75 million convertible note offering due 2033, including $113 million to refinance prior debt. The move swaps costly, restrictive loans for flexible, low-rate dilution, freeing up $94 million in cash and easing leverage. This signals a shift from relying on equity dilution or pure debt for growth. Convertible notes are now its middle path to rebuild investor confidence. It reflects a recalibration of its financial leverage strategy. On the other hand, BlackSky also released Q2 preliminary results after hours showing $22.2 million in revenue, down 11% year-over-year. Engineering services dropped from $74.7 million to $42.2 million, exposing volatility outside imagery. Core imagery and analytics grew just 3%, showing stagnation. Customers delayed Gen 3 satellite deployments, slowing recurring revenue and contract conversions. Despite Gen 3's touted tech, rollout is slower than expected. Uncertainty in U.S. government budgets and contract timing forced BlackSky to cut 2025 revenue forecast to $105 to $130 million and revise EBITDA back toward break-even. Though product direction is AI-driven and high-frequency, real-world execution remains tangled in defense cycle delays. That's why BlackSky exited loan covenants early to hold more cash against volatility. Cash at June end stood at $94.9 million, nearly double year-over-year. $90 million came from H1 equity raises and ATM offerings, showing limited but still functional access to capital markets. However, operating cash flow remains negative. Capital expenditure remains high at $60 to $70 million, with Gen 3 still in build-out phase. The timing gap is critical. If Gen 3 investment, platform upgrades, and international contracts don't generate recurring revenue by early 2026, the new debt becomes risk, not leverage. Interestingly, BlackSky reaffirmed its 3 to 5 year targets: 20 to 30% revenue CAGR, 80+% imagery gross margin, 75+% total gross margin, and 40+% EBITDA margin. Ambitious, but hard to justify now given over-reliance on government contracts, contract delays, and weak free cash flow. Positively, 2 days ago, BlackSky won a competitive international contract. Though undisclosed, it marks a strategic shift, not just imagery licensing, but mission-based monitoring combining software subscriptions, real-time analytics, and localized ground control. This implies 3 key market signals. First, the deal includes real-time, AI-driven image analysis tied to Gen 2 and Gen 3 hybrid constellations. Orders and tasking run via Spectra platform, highlighting progress in SaaS execution. BlackSky moves from asset owner to solution provider. SaaS revenue improves stickiness and valuation multiples, a key goal for Earth observation firms. Second, the deal localizes ground infrastructure. Direct downlink and sovereign in-country decoding reduce reliance on U.S. or Chinese space assets, a huge differentiator from middle-power governments. BlackSky has found a geopolitical white space. This allows it to address defense, border, maritime, and gray zone monitoring needs in fragile states. If scalable, it could define BlackSky's future. The broader industry shows bifurcation. Planet Labs targets commercial imaging and ESG, while BlackSky and Capella Space focus on defense. BlackSky's strength is vertical integration from satellite build to AI analytics, not reliant on third-party infrastructure. High capex, but better for long-term defense contracts. Market cap recently peaked near $900 million, now correcting below $700 million post-announcement after hours. If its hybrid contract model spreads globally, ARR and margins may jump in 12 to 18 months, justifying recent upside. If Gen 3 proves mission-adaptable and weather-resilient, valuation could align with Palantir's defense tech profile. Yet risk remains. Commercial pivot speed and customer diversification are unclear. Too much reliance on governments makes it a volatile bet. Past dilutions weakened investor trust. Without real ARR gains and multi-client proof, this rally may fade. Still, the new contract reflects a maturing business model. If BlackSky can repeat this with Gen 3 and localized ops, it could lead sovereign surveillance solutions globally. In today's geopolitical climate, that's more valuable than any single contract. BlackSky's 70% gross margin shows Spectra's business and technical edge. Compared to R&D-heavy space startups, it has real contracts, like a $24 million NGA deal, proof of trust in its monitoring. Balance sheet is solid, with 3.79 current ratio, strong short-term liquidity, and conservative leverage. But profitability hinges on whether Gen 3 expands use cases and client willingness to pay. Contract highlights include tip and queue capabilities, Gen 2 detects anomalies, Gen 3 zooms in. This multi-satellite coordination is valuable for military use. CEO O'Toole emphasized its advantage, but market willingness to pay still needs validation. BlackSky has 2 Gen 3 satellites in orbit targeting 6 by 2025. A multispectral satellite is planned for 2027. Ambitious, but it requires capital. Maintaining funding without dilution is a challenge. Both H.C. Wainwright and Canaccord raised price targets, expecting $137 million in revenue in 2025. But assumptions rely heavily on ongoing geopolitical tensions. If conflicts pool or budgets shift, demand could reverse. BlackSky, like early Palantir, has customer concentration risk. It's a classic space-to-real-world case, aiming to be a real-time satellite data platform, not a passive imagery vendor, but a mission-driven analytics player. Still early stage, with high risk and high reward, if 2025 shows post-expansion revenue growth and AI and multispectral applications gain civilian traction in insurance, agtech, logistics, it could unlock a next valuation leg. Today's price likely reflects short-term geopolitical tailwinds, not yet fundamental transformation.
The analysis here is intended for informational and educational purposes only, to help understand the business developments and financial positioning of related companies from an investor's perspective. This is not financial advice. On the other hand, NVIDIA and AMD received U.S. government approval to resume AI chip exports to China. This immediately lifted near-term revenue and stock sentiment. NVIDIA plans to resume H20 shipments. According to Commerce Secretary Gina Raimondo, this export approval is linked to U.S.-China rare earth negotiations. It reflects a strategic tech-for-materials trade-off. AI export rules are now a bargaining tool in U.S. diplomacy. NVIDIA is not fully autonomous in setting China's strategy. Political risks in China remain high and unpredictable. The current export window gives NVIDIA a short-term lift toward the $170 level. NVIDIA's moat includes chip performance and dominance of the CUDA software ecosystem. CUDA is the de facto global standard in AI model development and inference. Global developers rely heavily on NVIDIA's stack. Bloomberg Intelligence estimates the H20 ban threatened up to $15 billion in annual revenue. With shipments resuming, NVIDIA could recover $4 to $5 billion. Orders for H20 alone totaled $8 billion in FY 2025 Q2. This eases pressure on supply chain and capacity management. Demand for H100, B100, and mid-range H20 GPUs remains strong. AMD's MI308 also received clearance. Though China data center share is small, regaining shipment access gives AMD incremental volume. With rising demand for image generation, LLMs, and medical AI, AMD's MI300 series offers strong performance to price value. Cloud providers like Alibaba, Tencent, Baidu, and ByteDance also benefit. These firms had been shifting to Huawei's Ascend chips under U.S. sanctions. They can now reassess NVIDIA and AMD's architecture advantages. Short-term, this boosts data center purchases and accelerates proprietary model deployment. It drives restocking across PCB, thermal, server, and CUDA ecosystem suppliers. Midterm, the policy whiplash has destabilized business expectations in China. This is a compliance cap, not a strategic commitment. U.S. may tighten controls again based on political or military considerations. NVIDIA CEO Jensen Huang's visit to China, talks with Trump, and state media exposure suggest this was a negotiated concession. Even if H20 underperforms H100, Chinese developers can still train and infer with it. They can continue using CUDA and PyTorch, but this leaves the door open for renewed policy shifts post-2025. This instability accelerates China's domestic chip development. Long-term, NVIDIA risks losing a $10 billion plus fast-growing market and its global software monopoly power. a dual-track AI chip market may emerge. In open markets like the US, EU, India, and Middle East, NVDA and AMD lead with top chips and stable supply. In restricted markets like China, Russia, and parts of Southeast Asia, local chips and open-source tools will form independent ecosystems. These evolve more slowly, but are policy resilient. Key near-term watch points include Q3, Q4 shipments, especially H20 delivery pace and software ecosystem dominance. Will China accelerate adoption of local alternatives due to policy volatility? Will the U.S. Congress or the next administration reimpose stricter rules in 2025, possibly expanding dual-use definitions? Loop Capital analyst Ananda Barua recently raised NVIDIA's price target to $250 with the $6 trillion valuation estimate. For a $3.7 trillion company with modest year-to-date gains, this implies a high-confidence growth outlook. His model sees NVIDIA reinforcing its AI GPU dominance and leading a $2 trillion global GPU investment wave by 2028, capturing up to 60% of compute workloads, far above today's 15%. NVIDIA itself reported visibility into multiple gigawatt-scale AI infra projects. Each gigawatt could bring $40 to $50 billion in revenue. UBS's conservative forecast of 20 gigawatts implies $1 trillion in cumulative sales. The key uncertainty is whether this converts into sustained earnings and valuation. Barua forecasts NVIDIA will ship 6.5 million GPUs in 2025 and 7.5 million in 2026. ASPs are projected above $40K each, mostly H100, B100, and future Blackwell series. These chips are the backbone of hyperscaler AI infrastructure. Still, can those volumes and prices alone justify a $6 trillion valuation? Even Barua admits valuation compression is a key risk. NVIDIA's PE has stayed high due to its perceived monopoly on AI. But this may shift as AMD, Intel, Google, Amazon, and Microsoft ramp up internal chips. If pricing weakens, margins could fall, triggering a valuation reset. Another risk is cyclical demand. AI enthusiasm is high, but can model demand scale indefinitely? Can data centers absorb rising compute density, power, and cooling needs? If we see overinvestment, weaker demand, or persistent supply constraints, even strong shipments may not support the growth narrative. Investor sentiment toward NVIDIA is at an inflection point. The stock has moved less this year than in 2023's explosive rally. With institutional ownership already high, even good news may not lift prices much further. Some hedge fund managers now ask, what's left to re-rate NVIDIA? Sentiment has shifted from euphoria to cautious optimism. Can NVIDIA rise from $3.7 trillion to $6 trillion? It's a high-risk, high-reward scenario. The bet depends on aggressive supply chain forecasts and valuation durability. Long-term holders are wagering on global AI penetration. Traders are betting on timing and policy outcomes. NVIDIA still leads on tech, capital, and customer relationships, but expectations are now priced for perfection. Last quarter revenue reached $44.1 billion, up 69% year over year. Data center revenue was $39.1 billion, up 73%. This confirms strong Gen AI compute demand. Still, the headline story wasn't revenue. It was a $4.54 billion charge tied to H20 inventory and purchase obligations due to April 9th export restrictions. This pulled GAAP gross margin down to 60.5% from 78.4% last year. Non-GAAP margin was 61.0%. Excluding the write-off, adjusted margin would be 71.3%, showing NVIDIA's real profitability potential. But it also exposed NVIDIA's blind spot. It engineered H20 to bypass export controls and keep China sales. The strategy failed, leading to real financial damage and regulatory questions. As the world's largest AI chip maker and geopolitical asset, NVIDIA must now manage political risk and supply chain flexibility more proactively. NVIDIA generated $27.4 billion in operating cash flow and $26.1 billion in free cash flow this quarter, far above last year. Over $14 billion in stock buybacks were completed in Q1. CapEx is now rising, with heavy investments in U.S.-based AI factories. NVIDIA is moving from a lean model to capital-intensive infrastructure. This may pressure OpEx in future quarters. The Blackwell platform now spans cloud, edge, automotive, and robotics. NVIDIA launched Blackwell Ultra and integrated NLink Fusion and DGX Cloud Lepton.
The ecosystem play, anchored by AWS, Google Cloud, and Oracle, aims to bind the industry to NVIDIA's architecture. But this relies on sustaining technical leadership and supply dominance. If AMD, Intel, or Amazon break through with credible alternatives, NVIDIA's pricing and profit structure could be challenged. Non-GAAP OPEX rose 43% year-over-year to $3.58 billion. Q2 OPEX is expected to reach $4 billion. NVIDIA guides for full-year OPEX to grow at a mid-30% pace. This supports R&D and go-to-market expansion, but could compress margins if revenue growth slows. The latest results show both sides of NVIDIA's AI leadership: exceptional execution and structural vulnerabilities. Long-term success will depend on building a more diversified, compliant, and resilient global supply and sales network. If Q2 hits $45 billion in revenue and maintains 72% margins, confidence in its model may rebound. But the real test is whether NVIDIA can stabilize its global platform over the next 12 months. That will determine whether its valuation can rise and stay at the next trillion-dollar threshold.